Dear students, let us continue the income tax class. We have already seen that tax rates for every assessment year are prescribed in the Annual Finance Act, presented before the Parliament every year. The normal tax rates are prescribed in the Finance Act, and every year the Finance Act first schedule prescribe the tax rates, and this schedule is divided into 4 parts. The first part contains tax rates for the current assessment year. Current assessment year means, let us take the assessment year commencing on the first day of April 2024. Then assessment year 24-25 is the current assessment year. If the assessment year commences on the first day of April 2023, then the assessment year will be 23-24 and like that. And the tax rates for the current assessment year is prescribed in the part 1 of the first schedule. So in the Finance Act, our Finance Minister has presented before the Parliament on the first day of February 2024, contains the tax rates applicable for the assessment year 2024-25. That is part 1. The part 2 of the financial year will contain the rates of tax for deduction of tax at source or collection of tax at source during the current financial year. Current financial year means the financial year commencing on the first day of April every year to the following 31st March. Now a current financial year is in progress, which started on the first day of April 2023 and will end on the 31st day of March 2024. And then the first day of April 2024, another financial year will commence. The rates of TDS or TCS for the financial year 23-24 are contained in Part 2 of the Finance Act 2023, and similarly, the rates for TDS or TCS to be made during the financial year 24-25 will be prescribed in Part 2 of the Finance Act 24. And the Part 3 of the Finance Act will contain the rates for deduction of tax at source from salary and also for computation of advance tax payable during a current financial year. So the tax due on the income of a person, when computed, if it exceeds 10,000 rupees, should be paid in advance during the previous year itself. That means in the year in which income is earned. And there are certain provisions for payment of the advance tax contained in section 2007 to 2010, and such rates of advance tax are contained in Part 3 of the Finance Act. See, you have to bear in mind that the tax rates prescribed in Part 3 of a Finance Act will become Part 1 of the next Finance Act. For example, Part 3 of the Finance Act 2023 will become Part 1 of the Finance Act 24. And Part 3 of the Finance Act 24 will become Part 1 of the Finance Act 2025. Because taxes on the income earned by a person in a previous year should be paid either by way of deduction or collection at source or by way of payment of advance tax. Therefore, that tax rates have to be announced in advance. That is how in Part 3 of every Finance Act, the rates of TDS or advance tax calculations are given, based on which in the next financial year taxes are deducted or collected at source. So we have already seen that normally the income earned in a previous year is brought to tax in the assessment year. We have already seen this. The base for levy of tax in the assessment year is normally the income of the previous year. That is the general rule. For example, income earned in the previous year is assessed in the assessment year 24-25. Here, 23-24 is the previous year and 24-25 is the assessment year. That is, previous year is the financial year immediately preceding the assessment year, like that. So, to the general rule that income earned in the previous year should be taxed in the assessment year is subject to certain exceptions contained in the Income Tax Act. These exceptions are provided for the benefit of the revenue, that is the government. To safeguard the interest of the revenue, we can say certain incomes are taxed in the year in which it is earned. Examples of such income are given in the Income Tax Act itself. Number 1, Section 172 of the Income Tax Act provides that in the case of any ship belonging to or chartered by a non-resident, which carries passengers, livestock, goods, etc., shipped at a port in India. Repeat, the case of a ship belonging to a non-resident or chartered by a non-resident, which carries passengers, livestock, goods, etc., shipped at a port in India. The owner of the ship or charterer of the ship will be allowed to leave the port in India only if the master of the ship files a return of income giving the income earned from the freight earned from such carriage of goods or passengers before the ship is allowed to leave the Indian port. The master of the ship is given the responsibility to deduct 7.5% of the freight or fares collected by the ship, and such 7.5% of income is deemed to accrue in India in that previous year, and tax has to be paid before the ship leaves the Indian port, or satisfactory arrangements should be made by the master of the ship for payment of such taxes. And only then a port clearance certificate shall be granted for its departure. Now, why such exception is given? Normally, the income earned in that previous year is taxable to the next assessment. For example, a chartered ship is leaving an Indian port on 31st December 2023. And with a lot of goods shipped from India. Definitely, for carrying such goods, or if it is passengers, the master of the ship will collect either freight or fares from the concerned parties. So, suppose that ship does not belong to an Indian owner. It has come from a foreign country. We don't know if it leaves India when it will come back to India. If we wait for the assessment year and tax that income, then collection of the tax may become difficult, because there is no guarantee that that ship will come back to India in the next assessment year or shortly thereafter. And that is why income is fixed at a presumptive rate that we can say it is a presumptive way of taxation. Out of the freight received or fare received, 7.5% of it is treated as the net income taxable in India, and tax should be paid thereon. So it should be paid before the ship leaves the Indian port. So as far as the government of India is concerned, the tax due thereon is already collected before the ship is given a port clearance. That is section 172, the shipping business of non-residents. The next section 174 says, so there may be certain cases when even Indian citizens may leave India during a particular previous year for employment or for some other purposes, and they may have no intention of returning to India. And in case they have income earned in the previous year, up to the period of their departure, after their departure, collection of tax on that particular income will become difficult. Therefore, a provision has been made in section 174 stating that if it appears to the assessing officer that any individual may leave India during the current assessment year or shortly after its expiry with no intention of returning to India, then the total income of such individual up to the date of his departure from India shall be chargeable to tax in the assessment year itself at the rate in force in that assessment year. So, a person leaving India has to pay tax on the income earned up to the date of his departure. For example, a person is leaving India on 31st January 2024 with no intention to return to India. During 23-24, he had earned an income of 10 lakh rupees in India up to the date of his departure. If he is allowed to leave India without paying tax thereon, it will be very difficult for the department to collect tax thereon after he left India. That is why a section, namely section 174, has been introduced in the income tax act, providing that the tax on the income up to the date of the departure of that particular individual should be paid at the rate in force in that year. If he is leaving in on 31st January 24, it is assessment year 23-24. Normally that income will be taxed only in 24-25. But in this particular exceptional case, the income will be taxed in the assessment year 23-24 itself, and he will be allowed to leave India only after payment of that tax amount. That is the second exception. Similarly, there are certain circumstances that certain AOP or body of individuals, etc., formed for a particular event or purpose and dissolved shortly thereafter, and they have earned a lot of income. An associate persons may contain in itself individuals, HCF, partnership firm, company, etc. Once they have joined together and conducted some activity and earned income therefrom, and thereafter it is dissolved in that year itself, they have shared whatever income earned they have between themselves. Then thereafter, if an assessment is made in the assessment year, that is after the expiry of that previous year, as in the normal case, tax collection will be difficult. Therefore, if it appears to the assessing officer that during any current assessment year, any AOP or BOP, etc., formed for a particular purpose is likely to be dissolved in that assessment year in which it was formed or immediately thereafter, the total income of such AOP up to the date of its dissolution shall be chargeable to tax in that assessment year itself at the rate in force in that assessment year. Let us take an example. XYZ is an AOP. It was formed for conducting an exhibition in some place in Kollam, അല്ലെങ്കിൽ different parts of Kerala. They were formed in the month of April 2023, and after conducting exhibitions in different parts of Kerala, they have decided to dissolve with effect from 1st day of February 2024. That is before the expiry of the relevant previous year. And the income earned in this previous year will be taxed only in the next assessment year 24-25. But once this AOP is dissolved, and we are waiting for the assessment year to come and make the assessment fixing the tax liability on the AOP. The persons who have joined the AOP must have gone to different places and will be difficult to locate them for collection of the taxes. So, such a risk will be prejudicial to the interest of revenue. Therefore, our lawmakers have made a provision in the Income Tax Act by way of Section 175, providing that if it appears to the AO, the AO means assessing officer, during the current assessment year, that an AOP has been formed and is likely to be dissolved before the end of the previous year, then the total income of such AOP or maybe BOI, body of individual, shall be chargeable to tax in that year itself at the rates in force, whatever may be the rate in force in that year. At that rate, their income has to be taxed, so that before dissolution, the tax due on their income can be levied and collected. That is Section 174. 174A. 174 is person living in India, and regarding AOP, BOP formed and dissolved in the year, the section is 174 capital A. It is Section 174A which prescribes taxing the income of the AOP formed and dissolved in the year itself to tax its income after the date of its dissolution in that year itself at the rate in force. That is Section 174A. That is the third exception. So we have now seen three exceptions. Number one, shipping business of non-resident. Number two, persons living in India. Number three, AOP and BOI formed and dissolved in the same previous year. And now the fourth one is persons likely to alienate property to avoid a tax. Alienate means transfer or charge or sell, transfer, etc. Section 175 says, if it appears to the assessing officer during any current assessment year that any person is likely to charge, sell, transfer, dispose of, or otherwise part with any of his assets or their assets with a view to avoiding payment of tax. Let us analyze it. The assessing officer fears that a person is likely to transfer or dispose of his property with a view for the purpose of avoiding tax payment. Suppose X is a person from whom a certain amount of taxes are due to the department. It is outstanding for a long period. He has certain assets in India. He is still doing business. Then on a fine morning, the assessing officer has got information that X is trying to sell his property to somebody else, and may leave India or may go to some other places, whatever may be the reason, he is trying to sell his assets. So the income being earned in the previous year, in the particular assessment 23-24 up to 31st March, he is doing business also. Then the assessing officer can take action to tax his income from the first day of the said assessment year up to the date of commencement of the proceedings under section 175 in that year itself. Suppose 23-24 is the assessment year. And the income earned in the year 23-24 will be assessed only in 24-25. And 24-25 assessment year will start only on first day of April 24. So before that, he is proposing to transfer his assets. At the same time, he is doing business. He is selling his business. Then whatever income he may have earned up to the date of transferring his asset or selling his business has to be assessed and tax thereon should be collected. If the assessing officer is of the opinion that he is trying to sell his assets to avoid payment of tax, then the total income of such a person from first day of April of that assessment year, that is from first day of April 23 to the date of commencement of the proceedings. There is only an apprehension that he is trying. It may be correct or may not be correct. But when such an apprehension has come to the notice of the assessing officer, he has to proceed with the assessment proceedings as prescribed in section 175 of the Income Tax Act to tax his income up to the date of commencement of the action. He will be transferring or selling his property. This is assessment year. So from the commencement of the assessment year, he is doing business. So from the date of commencement to the date of the proceedings to tax his income is started now. Income has to be computed. Then tax due thereon has to be collected from him. It is that income is chargeable to tax in that assessment year. You have to understand that this income is normally taxable in the assessment year, which will start only in the first day of April 24. If you wait up to that day, this person will transfer his property and will go away. So then collection of the tax on the income earned up to the date of his departure, on the day till the date of selling of his assets or business, will be very difficult. That is the reason why Section 175 has been included in the Income Tax Act. Let us take an example. The assessing officer in a particular case notices on 19th November 2023 that X Limited is likely to dispose of a house property during January 24 with a view to avoid payment of income tax outstanding against the company. Therefore, the assessing officer issues a notice on 30th November to X Limited to submit their return of income for the period from 1st day of April 2023 to 30th November 2023. See, April 23 to November 23 is the period falling in the previous year 23-24, and the income of that period will be taxable only in the next assessment year commencing on 1st day April 24. Here the assessing officer requires the company to submit their return of income, disclosing the income for the period from April 23 to November 23. And in that case, the income for that period is chargeable to tax in the assessment year 23-24 itself, and not 24-25, which is a normal assessment year. And that income will be chargeable to tax at the rate in force in that assessment year. So as I have already told you, these are all provisions to safeguard the interest of revenue. That is the fourth exception. And there is another exception, exception 5. It deals with discontinuance of business, Section 176 of the Income Tax Act. See, it may be possible that a business being continued for so many years will be closed from a particular date in a particular previous year. In that case, if the business is discontinued in any assessment year, let us say assessment year 23-24, the income of the period from the expiry of the previous year for that assessment year up to the date of such discontinuance may be charged to tax in that assessment year, and that too at the discretion of the assessing officer, that the rate enforced. See, the business is discontinued in an assessment year. Suppose the assessment year is 23-24. In the assessment year 23-24, normally the income earned in the previous year 22-23 will be taxable, and the income earned in the previous year 23-24 will be taxable only in the assessment 24-25. But there is information that the business is discontinued in that assessment year itself. In that case, the income of the period from the expiry of the previous year for that assessment year (23-24) assessment year previous year is 22-23, that is April 23. From April 23, up to the date of such discontinuance, to the date of such discontinuance, maybe you have to take that date from with effect from which date the business is being discontinued. If that business is discontinued with effect from 1st day of July 2024, income for the period from 1st day of April 24 to 31st July 24 will be chargeable to tax in that year itself. Normally, the income earned in the year 24-25 will be taxable only in 24-25. Let us take another example. The business is discontinued with effect from 1st day of November 23. 1st day of November 23. November 23 is the it is the financial year November 23-24, the relevant income is taxable in 24-25. And the income earned in the previous year 22-23 is taxable in the assessment year 23-24. But here, the income earned in the previous year 23-24 will be taxed in that previous year itself. That previous year becomes the assessment year for the earlier previous year. So 23-24 is, as I have already told you, it is an assessment year as well as a previous year. 23-24 is the assessment year for the previous year 22-23, and at the same time previous year for the assessment year 24-25. So 24-25, if that is the assessment year, and the business is discontinued in that assessment year, take the income from the 1st day of April to that date and bring it to tax in that year itself. And a discretion has been given to the assessing officer whether it has been taxed or not, whether the person discontinuing the business will be in India or not, etc., etc. That is not our consideration. Anyway, that is the fifth exception given in the Income Tax Act regarding taxation of income earned in the assessment year, in that assessment year itself. You have to properly understand this, because income earned in an assessment year is taxable in the next assessment year, because that assessment year will be a previous year for that assessment year. But it is taxed in that year itself, the year in which it is earned itself. Normally that should have been its previous year. Will be taxed only in the next assessment year. But here they say it should be taxed in that year itself if the business is discontinued, and that is the provision given in section 176. So we have seen sections 172 to 176. Is 172, there is no section 173 is not applicable here. Section 172, section 174, section 174 capital A, section 175, section 176. Section 176 deals with discontinued business. Section 175 deals with persons likely to transfer their property. Section 174A deals with formation and dissolution of AOP, etc. And Section 174 deals with persons leaving India, and Section 172 deals with income of non-resident shipping business. In all these cases, instead of waiting for the assessment year, the income earned by in these cases will be taxed in the year in which the income is earned. And the assessments so made are called accelerated assessments, because the assessment has to be made only in the next year normally. Here we make the assessment earlier than the normal time. That is why the assessments made under Section 172, 176 are called accelerated assessments. And these are the exceptions given to the taxation of income in the year in which the income earned itself, instead of taxing it in the normal assessment year. So now we have to see the scope of total income. I have already told you that scope of total income means the extent of total income of a person, and that is based on residential status of the person. Section 5 of the Income Tax Act deal with these provisions. According to this section, in the case of a resident and ordinarily resident person, his world income is taxable in India. A world income in the sense that whatever income he has received in India, deemed to be received in India, accrued in India, deemed to accrue or arise in India, and accruing or arising outside India. Wherever the income was earned by him, or received by him, or accrued for him, that income will be taxable in India, provided he is resident in India during that assessment year, the relevant previous year of that assessment year. We will see the rules for determination of residential status in a different class. In the case of individuals and HCF, the residential status may be resident but not totally resident also. They may be resident and ordinarily resident. At the same time, they may also be resident but not ordinarily resident also. In the case of a resident but not ordinarily resident, which is applicable to individuals and HCF only, their income accruing or arising outside India is taxable in India only if it is from a business controlled in India or profession set up in India. All other incomes are taxable in India. And in the case of a non-resident, income accruing or arising to them outside India is not taxable in India. All other incomes are taxable in India. So, the extent of income to be considered for taxation in India, what is called the scope of total income, is defined in Section 5, and that is based on the residential status of the concerned person, and the rules for determination of residential status we will discuss in the next class. Okay, thank you.